All right, I've shown 9 o'clock on our clock here, so I'm going to go ahead and call our meeting to order. We have, I guess you do a roll call first. So John Vischer, member.
David Rader, member.
Matt Barker, member.
Patrick Keogh, member.
Martin Lewis, member.
Hey guys.
Greg Williams, staff.
William Johnston, staff.
Brendan Vavrika, Anco Consulting.
If you guys would like to state your names for the minutes.
Andrew Murray, Bailey Gifford.
Alexia Haramis, Bailey Gifford.
Fantastic. All right, we have an agenda before us. We're very happy to entertain a motion to adopt. A motion, got a second? All in favor? Aye. We have the minutes from last meeting.
Move the approval.
Do I have a second?
Second.
All in favor, please say aye.
Aye.
Minutes have been approved. All right. We have our friends from Bailey Gifford who just rolled in, so it's great to have you guys here. So you're up next. As you are probably well aware, we're a rather interactive group, so while you're presenting, if we can, stop and ask questions, if that's okay with you, that'd be fantastic.
That's great. Thank you very much, John. I'll let Alexia go around with some of our materials for the presentation. And thank you very much for having us. It's always a pleasure to be here. My name's Andrew Murray. I think I've been coming to Gainesville for the last 10 years or so, COVID aside. I really appreciate the opportunity to come here in person on an annual basis. I'm joined by my colleague Alexia Haramis, who's just handing out some of our presentation materials. We both work in the client department at Bailey Gifford, so we're all both focused on a team that service clients who are based in the east coast of the US, and that's our full-time job. So we're here today to provide an annual update on the firm, portfolio, importantly performance, which we fully appreciate has been disappointing for the last few years, and also at this time some comments on the outlook. Mr. Chairman, does that sound like an...
Absolutely,
okay?
yep.
So we'll aim for 10 to 15 minutes. I'll ask Alexia to start with some updates on the firm and portfolio, and then I'll provide some comments and hopefully answer some questions as well on performance. But please do ask questions as we go through the presentation. It's always much more enjoyable. As you said, you're an interactive group, and we really appreciate those interactions.
Great, fantastic. Alexia, please.
Hello, good morning. I'm Alexia Haramis, Client Manager at Bailey Gifford. Pleasure to be here and delighted to provide you with a firm update. First and foremost, I wanted to highlight the stability of the firm. There have been no changes in ownership or in the people managing your assets. And assets under management in the firm were $285 billion. And you are invested in the International Mutual Growth Fund. Assets under management in the International Growth Strategy, $48 billion, and of which $3 billion are invested in the International Mutual Growth Fund. So much has happened over the last quarter and last year since we've seen you. As mentioned, the firm remains stable. However, we're always striving to improve and make improvements. So I'll provide you with a few examples of some of the things that we've been up to. So most recently, we've been excited to welcome 10 new equity trainees who have joined the firm just this month, and they will be rotating throughout our investment floor, and they will be gaining investment knowledge while they carry out placements over a 5-year period. So we very much so look forward to seeing how they develop in time. The second update would be within our trading team. We already have a trading desk in Hong Kong and in Edinburgh. There are plans now to open a trading desk in the US, and we will be moving 2 colleagues across from our Edinburgh trade team to work in the US. And this has really come about from the changes to T1 settlement period. And we also see that there will be other opportunities and benefits for our trading operations with that move going forwards. There is also another update. We have recently published our first diversity and inclusion report for the firm, focusing on attracting, developing and retaining staff and creating a culture of diversity and inclusion. So much has been done to really improve diversity and equity across the firm. However, we acknowledge that we're in the early stages of that journey going forwards. So those are sort of a couple of the key updates for the firm. Do you have any questions on those updates?
You mentioned that the 10 new trainees, is this like normal time when you bring new people in? I mean, that's just,
That's right.
okay.
Yes, so that's on an annual basis that we bring in new trainees and train them up on a 5-year period. That's
Okay.
right, yes.
All right. Any questions?
What's the retention like on those people?
It's pretty high, actually. Obviously, we can't always guarantee, and they come from a diverse background, so internationally, and diverse background, you know, from what they've studied as well. So we tend to retain about 50% of them over time.
Yeah, I think in terms of the investment staff, turnover is very low. On the floor of 160 odd staff, it's less than 5% turnover. Of the graduates who come in being young, they don't know if they want to be investment managers for their lives, and they'll discover that in the next 5 years. And are they if they're an investment manager, are they a growth manager, or are they a value manager? So I think we'd expect and hope that, you know, that cohort in 10 years' time or 15 years' time, you know, roughly half of them are still with the firm because they do want to be investment managers, and they do want to be growth investment managers, and they're good at it. So that's the sort of whittling process that goes on. But we want to recruit people that ideally will spend their entire career if there is a fit.
That's right. So if you would like, I can continue and give you a little bit of an update with regards to the portfolio holdings. And as you will see on the handout, there are highlighted within the columns in colour. You can see the holding periods for each stock. So we actually, you can probably see that during about 60% of the portfolio is held over over 5 years. Nevertheless, there has been many research meetings taking place, stock discussions and transactions over the last 12 months, and you can see those featured on the table. So, for example, we have trimmed a couple of holdings, ASML and Ferrari, due to these two ones performing very well, and we've decided to trim them to fund some smaller positions in some of the new ideas for the portfolio. There are also, just to highlight that we've also reduced some China exposure, so Alibaba and Tencent we've also reduced over the last year. And AIA, which is the Pan-Asian insurer, we've actually added to, their stock price has gone down due to the repercussions from the lockdown in China. So there's been an opportunity to add to that holding. You will also see on the table marked with NB the new buys. So there have been 9 new buys over the last 12-month period, and we're really excited about the opportunities for those new buys. And those can broadly be divided up into 3 themes. So we have the businesses that are poised to really benefit from the energy transition. So businesses such as Solar Edge that manufacture solar inverters. And there's a company, Promismian, which is an Italian cable manufacturer. They manufacture cables that are submarine cables, and they have a 40% market share in that particular type. And those can be used in offshore wind energy farms. And then there's Kangfang, for example, which also fits within the sort of energy transition theme, and that's one of the largest producers of lithium in the world. One of the second themes is the growing fintech solutions companies such as New Holdings and Wise. And thirdly, we have the businesses that are semiconductors and tech hardware businesses such as VAT Group, AutoCare and Mobileye. So those are the 3 themes for the new buys. You can also see at the bottom of the table in red that complete sales. These are sales that have been prompted by lower growth expectations and better opportunities in other ideas. You'll probably recognize particularly Stellantis and Indidex, which are 2 holdings which we've held for over a decade in the fund and that have performed very well. However, we've now decided that there are other holdings that are more exciting opportunities for you. Happy to take any questions.
Could you just refresh the group sort of the expectation when you're looking to buy a company in terms of the growth rate and so forth, that your hurdle rate? Could you just refresh our memories on that?
Yeah, so we're looking for companies that will at least double in value over a 5-year time frame. every company is different, and the scenario in which it will double over a 5-year time frame will be different. So some companies are slower compounding companies that you might actually think it's possibly a bit longer than 5 years, but the risk of it not doing that are lower. So we've talked about Inditex and Stellantis. There were great companies that we owned for a decade, compounders that steadily grew at a reliable, predictable way because of the durable competitive advantage they had. There are other companies in the portfolio where the probability of success might be lower, but we might have a higher bar in terms of what we'd expect in terms of payoff. So there's some companies where we might be thinking it's a 3 or 4 times upside, but there are transformational companies, whether it's a biotech or a software company. So that rule around doubling in 5 years is a sort of a guidepost, and companies are going to approach that differently. And I'd say that historically there's been a sort of 50-50 split in the portfolio between sort of steady compounders and transformational companies.
Right.
That shift changed a little bit. We sort of lent into transformational companies. It's probably 60-40 now, and I guess we just need to constantly evolve with the landscape of the investment opportunity. In 10 years ago, it was all about e-commerce companies that were growing really quickly. Part of that ship has sailed now, so we're looking at new themes as sort of growth drivers, and there'll be different types of growth that we expect to come through in the portfolio.
I'm just curious, the complete sales you had, how many of those basically hit your price target? You said we don't think they're going to have the opportunity to continue growing, doubling 5 years. And how many said, hey, our thesis just didn't work out, we swung and missed, which happens, but I'm just kind of curious of those.
Yeah, and there'll be some in the kind of middle category as well, so some big winners, some fails, and some that kind of, middle and did okay. Alexia mentioned Stellantis, which was the company that was previously Fiat Chrysler Automotive. They merged with Peugeot, became Stellantis. That was a big win for us. So we owned that back in the day because we thought they had an interesting lineup of brands, Jeep, etc. They also owned Ferrari, which was a hidden gem. They spun out Ferrari. We would continue to hold that. So there's a sort of legacy owning from that original company. Not only did Fiat Chrysler do very well because of the brands and because of the management, Ferrari's done very well as well. So that's what we sold out, a big success. Inditex, likewise, we held for I think 15 or more years. Did very well. Successes: CureVac, Ping An Insurance. So CureVac's a biotech company that the idea that the sort of drug discovery program that they followed didn't work out. Ping An Insurance was a Chinese insurance company, as the name says, with lots of tech behind it. But we just found that they were investing in an ever broader array of tech solutions in tangential industries. And not only did the investment case become diluted, the sentiment towards China and tech in China fell apart. So we didn't make money for you. We lost money for you on Ping An Insurance. So a range of outcomes.
Okay.
And I think broadly speaking, though, we think of the money-weighted scenarios there. There was more money in Stellantis and Inditex over the last decade than there were in the other stocks. So in this small cohort, I would be confident that there would be net outperformance. But in another cohort of stocks,
Sure.
it's not always the case.
Just an example. Okay.
Yeah.
I appreciate that. Okay.
How do you think about dividends?
Dividends are important. They're important for some companies. From our point of view, in terms of buying companies, they're important for different companies in different ways. So we would expect one of our steady compounders to have. We would expect all companies to have disciplined capital allocation models. And in the case of a steady compounder, you'd expect them to be paying dividends. I think in a transformational growth company, what you'd expect in a really rapid growth company where the opportunity for them is to grab the market share quickly and expand, we would not encourage companies to pay dividends where they can be using that money more productively by reinvesting in the business. So we don't invest in companies based on a dividend model where we're looking for dividends to go up over time. We're investing in companies where typically there's an opportunity for them to invest in themselves and grow the business. But we do think about dividends as we model the kind of valuation scenarios going forward.
And how do you think also about political risk? That used to be a term. You couldn't talk about international investing without considering political. It hasn't come up yet.
Yeah, well.
And it seems to be top of mind increasingly.
Yeah.
Like Solar Edge, they have any ties to China?
Solar Edge is Israeli.
Israeli. Yes, absolutely.
They will have it.
So I think the China angle there is the competition that they'll face because China's so dominant in so many parts of the solar industry. And we can talk about China. It's an important topic.
But when you made the change in Tencent and Alibaba, for example, was political risk a consideration? Or?
Yes. And the context And I think it speaks to the broader China exposure in the portfolio.
But you've added TSMC.
Yes, yes. So China's a topic we've always had to think long and hard about. We're not selling out of China per se. Your exposure to China has come down. The fund's exposure to China has come down materially. I'm going to take a long-term view, but if you look at, and I always think of the end of 2019 as the moment before the world went a bit crazy. But if you look at that point, because asset prices for so many things have moved around, but the fund had about 16-17% in China at that point. Now it's about 10-11%. So it's taken a third of the money out of China. Part of that's been done by the market because shares prices have come down. And we think we're at about the allocation we'd want to be, because China is the largest market in the world. And so for an international portfolio, that's it's a very big market to ignore. We visit China regularly. We've got an office in China doing research. And we just see the level of innovation and the size of the market opportunity there as being something that's very hard to ignore. But there's obviously the geopolitical risk. There's an unpredictable government setting policies for different industries. So it's hard to, in the US or in Europe, you can see where government policy is going years in advance. In China, you don't have that visibility. So I think our reduction from 16-17% to 10-11 is a reflection of that nuance, but also the scale and innovation and ultimately global importance of China as a market. And it's something that we're wrestling with. So we've taken money out of the companies that we think are less aligned with the Chinese government's objectives. So an Alibaba and a Tencent, I think in China's government's eyes, these are, well, not frivolous, but they are consumer economy businesses helping people get their, toilet paper or groceries half an hour faster as a delivery. Whereas what they want to invest in is for China to be the dominant player in industry, in the energy transition, so in electric vehicles, in renewables. They want China to be self-sufficient in lots of industries. So we want to tweak the portfolio into areas that we are aligned with the Chinese government on in its own ambitions, and not be exposed to areas where there's more internal political risk. And we also recognise the global political risk. So that's a bit of a complicated, nuanced answer, but it's not as simple as saying we're sort of exiting China or really cutting back from any sort of exposure there.
But then why international? Why not domestic companies with the international exposure? I mean, you get the international exposure, but you reduce, I would think, the political risk.
So do you mean Chinese companies that are...
Well, McDonald's.
Oh, McDonald's, yeah.
I just stopped and got
Yeah.
$1 coffee on the way here, and 70% of their sales are international.
Yeah.
Much of which is in China.
Yeah. Yeah.
And
we have that exposure.
you do?
We do. So the 10-11% you're at now is the direct Chinese companies. There's, as ever, and all companies now are essentially global, the kind of companies we would invest in. So they've got sales going everywhere. Alexia mentioned taking money out of the likes of Alibaba and Tencent and putting it into AIA, which is a Hong Kong-listed Pan-Asian insurer, and a large part of its opportunity is ensuring the Chinese population are rising middle class without any social safety nets. And we just think that that trend, not only in China, in lots of other high population Southeast Asian markets, is growing. Kering is another good example in the portfolio, a fashion house that owns the brands such as Gucci, and a large part of its sales growth has been coming from China. So there is that element, and we are trying to play it both ways.
But if you think about insurers, for example, with Aflac, with enormous international exposure, but not arguably the political risk that an AIA.
Yeah. So I mean, it's a struggle, and I don't think the portfolio managers ever have a right number in mind. Where they are right now is a sort of constant source of tension around: is it too high? Is it too low? The too low argument would be China is the world's largest market, and it's the opportunity for companies to grow and scale up in that space. Not only domestic companies, but also overseas companies, as you're rightly pointing out. So it's just another market we can't ignore. And finding the right way to play it is exceptionally important. We've learned lessons the hard way from being on the wrong side of domestic politics in China. And we were here a few years ago talking about Tal Education as a company that had, on the face of it, huge growth prospects to help Chinese education at scale, but the government decided that was going to be a non-profit industry, and so we're not going to make all these calls right, but we are thinking deeply about where to place our chips on the table with respect to China, and it's something that portfolio managers take very seriously. We have, in our conversations with clients, China comes up a lot, and there's a real appreciation of the kind of sentiment and the rising power of China globally. Obviously, will cause friction, and I think there's a sense that that's not going to go away, even for the rest of our careers. There'll be that sort of ongoing.
But it must happen in Europe too. I mean, when you start, now that Germany is the sick man of Europe and that sort of thing, that the political risk in Europe has to be different today than it was a half dozen years ago.
Yes, and I think our hope is that some companies can succeed if they are facing a large enough growth opportunity and have the right management team in spite of the circumstances. So we've written in the past about Mercado Libre, which is a hazard a guess is one of the top stocks in terms of, if you look at the back of the handout, and I'm really keen to talk about performance because I feel like it's a topic we need to explain. But there's still 3 tables there showing the top and bottom performing stocks over 3 months, 12 months, and 5 years. Mercado Libre is amongst the top 3 over all those periods. It's a Brazilian e-commerce company, and the macroeconomic environment in Brazil has probably been about as difficult as you could find anywhere in the world, with inflation, political unrest, periods of massive instability. Yet a company like Mercado Libre on a 10-year view can, like we said before, become 3, 4, 5 times its size in share price terms, despite the political backdrop. So I think it's our job to try and find the right combination of companies that can succeed despite the right backdrop, or backdrops that are extremely favourable, but always be taking these things into consideration. But it'd be hard for an international portfolio to not be in Europe because of the cycle where we are in terms of the economic picture. Europe's such a big part of our index, and we're kind of determined to find the best companies in that universe that can succeed.
Very good. And again, your mandate from what as a strategic was to invest internationally. They don't have a lot of wiggle room. They have to maximize their opportunity set there now. Whether it's an allocation change, that's a different discussion. But we hire them to fish in those waters, and sometimes those waters are very bountiful, and sometimes they're not. And that's how it's established. So if you want to talk regarding performance or whatever else, again, the floor is yours. So please.
Well, I feel it's incumbent upon me, given where we are in the performance cycle for the strategy, to at least provide you with some comments and context. Please stop me, I don't want to go into too much detail, but on the back of the handout, you've got the performance returns for various periods, as well as some attribution numbers. Returns that we're showing you right now are not good enough, and we're sorry for that. Our stated objective is to outperform over 5 years. We've not been doing that at this point in time. Given our approach, which I think you know well, you've been a client for such a long time now, we are growth investors, indeed pronounced growth investors, probably growthier than the growth index would apply. We're very long term, so turnover is very low. We don't try and trade our way around market sentiment or the market environment. So I would hope that I and my colleagues, Kevin in the past and Stuart Riddell historically, have always talked about the fact that we will go through periods of underperformance, even over longer time frames, because of our sort of holding on through different cycles. But where we are now is not within what we were expected to deliver. We want to outperform over 5 years. The current situation is, with the volatility in the backdrop, is not something that we would have expected. It surprised us, and it surprised some of our clients. So you can see here, we are behind over 1, 3, and 5 years in terms of the performance. The strategy is ahead over a year to date and over periods of longer than 5 years. But I'd like to flag that we are providing numbers in our pack against the funds benchmark, which was EFI until 2019, and then the benchmark changed to MSCI ACWI ex-US in 2019. I think Johan Kopac's, I think you measure us against EFI growth, so there'll be some difference in the raw numbers there, and we're giving you numbers to the end of August. Nevertheless, the directional picture is the same. I appreciate the difficulties that will create. What happened this year was actually the strategy turned 20, so we've now got quite a long track record to look back on in terms of our ability to perform or not. And the graphic in the middle of the page here shows you the range of relative returns over different time frames. And as you can see on the back of the page, the first column, for 1 year, we outperform most of the time, but the range can be quite wide. So we outperform historically on 61% of rolling 1-year returns over that 20-year period. But if you go through to longer time frames, you'll see that the range narrows and we tend to outperform most of the time. And our stated ambition is to outperform by 2 to 3% over the index over rolling 5 years. We're not doing that right now, but the chart shows our track record is that 91% of the time we do that. So that's 168 out of 185 rolling 5-year periods. Currently we're in that 9% of the time when that's not happened. And I'd like to explain some of the moving parts behind the last 12 months.
Sure, please.
It's been 12 months since we were last here. And I think really the key things are 2 factors. One, the environment, which we can't give as an excuse, but it's a factor. And 2, some company specifics. And I think from my point of view, being in the client department, we sort of hoped at the start of this year that maybe the worst of the interest rate hiking cycle would have been behind us. At the start of 2023, but here we are. It's the end of September, and the Fed are still talking about not yet done in terms of fighting inflation, not yet done in terms of potential interest rate rises, and that's just a constant headwind in terms of our style of investing. The companies we own are all very long duration, so their values are based on cash flows way out in the future, and those are discounted more heavily in a higher interest rate environment. And then I'd call out China and Japan as sentiment stories as well. Obviously China, lots of geopolitical risk, you've mentioned that. There's a sentiment that's quite heavily weighing down on China, so an anti-China sentiment in markets, which we fully understand. Long lockdowns and then a very disappointing recovery when the lockdowns ended. There's a property crisis in China. So that's been a headwind to some of the Chinese holdings. And you can see in the table here, the 12-month attribution, bottom 5 stocks in grey, 2 of them are Chinese, so the 2 of the top detractors, Meituan and NIO, are Chinese companies, so that really comes through in the numbers. And likewise in Japan, 2 of the companies in this list, M3 and Nidec, are also Japanese companies. And in Japan, finally now you're seeing inflation for the first time in almost 30 years, or over 30 years. And actually, the idea of higher interest rates from a zero base in Japan as an expectation. So all of a sudden, banks are rallying hard, deep value stocks are doing very well in Japan, and growth is doing the absolute opposite. So a bunch of different sort of contextual factors there that are unhelpful. And then in terms of company specifics, there's always going to be some companies that hit problems. The vast majority of the companies in the portfolio are performing as we'd expect, and that's in the context of obviously consumers with their budgets squeezed and higher interest rates, but we think they're doing well operationally. There's always going to be some outliers, and I think there's one that really stands out that I should explain, and it's Adyen. And you can see Adyen is the top detracting stock for all of the periods in the tables here. So over 3 months, 12 months, and 5 years, Adyen is the stock that's hurt the portfolio performance the most. Adyen is it's a Dutch company. It's a payment processing company that effectively solves for complexity across omni-channel payments, across borders, across any sort of banking chain that customers might be using. So it helps companies work with customers anywhere and easily. And they recently reported, and I say recently, all this damage in terms of performance has happened in the last month and a half. Some numbers that show slower growth and lower margins. And the important thing here is that that's a double whammy that really spooked the market. Adyen had been a company that always over-delivered. Every single time it updates, and it only updates twice a year, not quarterly, it had beat expectations. So I think the idea of beating expectations had been built into expectations. So this double whammy has had a real massive impact on its valuation, and the shares are down a lot. What are we thinking? Obviously we're concerned. We've spent time with the management team, but we don't think the investment case is broken. The margins coming down as a result of them hiring quite aggressively to bring on new staff. They're doing that counter-cyclically. So you've heard company stories about these tech companies that are laying off staff. Adyen didn't hire staff. They slowed down hiring when talent was expensive, and they're speeding it up now when talent is cheap, unavailable. That makes sense to us, but it means that their cost base has gone up and it hasn't really impacted their profitability or their success yet. That will come through. And in the slower growth, that's confined to the US. There's a specific thing going on in the US market right now. The investment community are worried about that slowdown affecting them globally. The US market is 25% of their business. They're still growing in the US, albeit slower, and we're quite confident that the slowdown is isolated to one of their markets, not globally. So It's a really big impact on the portfolio. A company we're paying a lot of attention to. There'll always be stock specifics. This was quite a big one, at least right now, and one we're paying attention to. So I'll leave it there on the performance story, and really want to take some.
Your credit card in the EU, Adyen is the one that handles the transaction for you.
Well, Adyen
Generally, like Capital One or.
Yeah, so not necessarily though, because if it's a credit card like American Express, it might not go through Adyen. But if or sorry, it might go through Adyen, but it depends on who you're spending money with, whether the hotel or the restaurant chain, or so they work with McDonald's and Uber and a lot of these global brands that are pan world. They're ideally suited for. But there'll be other companies like it could be Stripe or it could be PayPal that would be in competition with them. So yeah.
Obviously, I think it was a comment, it was about a year or so ago, or a year and a half, you guys were blazing across the front page, I think it's Fortune magazine, so I thought that, so well, you just got cursed, because every time someone gets on Fortune, typically something bad happens shortly thereafter. So, yeah. So anyways, but I was, and then just from an operational standpoint, obviously the performance is, you said it's been disappointing, no kidding, we're in a cyclical era where your style's been out of favor. Part of me is, oh, that kind of stinks, and the other part is, well, what opportunity set now is bubbling up? When prices go down, if you have quality companies, one would think and hope that your expected return goes up because you're in the trough. So I'm just kind of curious, from an operational standpoint, are your management team, are they, in the fetal position in the corner of the room, when you go meeting with them, or are they kind of excited about the opportunity set that they have? So I'm just kind of curious that the sense, and it's hard to give a coherent discussion about every company. Now, really, each company's a unique organization, but as you talk to them, are they like, we're kind of worried about this, or like, okay, no, there's some opportunity set, and obviously they're not the only companies in their industry that are suffering. So if they're stronger, one would think and hope that some of the weaker competition falls out or mismanages themselves into non-existence. There's an opportunity set for the survivors. I'm just kind of curious your sense there.
Yeah, that's a really good question. Because I'm not a portfolio manager. I don't meet these companies directly, but you can only imagine that a lot of companies do feel very beat up, and it's a tough environment. I think there's a couple of things that really stood out for us, though. One is the environment has changed. Everybody has to acknowledge that reality. Interest rates are higher, and the market's going to value companies differently, and access to capital has completely changed. So in one sense, companies that were happily burning through cash and being loss-making because we and other managers and investors were happy to fund growth for the future, that's changed. So you've got a lot of companies that were, and I'm talking about that transformational side of the portfolio, not the compounders, companies that were once going through this spend cash now, grab market share, grow quickly, profit tomorrow, cutting back costs. So you'll have read about that in the US, but you had in a portfolio Spotify cutting its costs differently. That's the music streaming platform, so laying off a lot of staff, reducing costs. There's a company called C, Southeast is a Southeast Asian e-commerce and payments platform, with also some gaming. So they went in the space of 1 year from $500 million losses to $500 million profits by cutting costs and rationalizing the business. So we've seen a lot of companies swing from loss to profit or loss to lower to break even because of the market environment, and those companies were typically rewarded with better share prices. So a year ago we were saying to you we added to Spotify because it was so weak, and in the portfolio now you can see we've taken money away from Spotify because it's cut costs, it's shown more profitability, the market's rewarded it, and we've seen that as an opportunity to take a bit of money away and add it to some of the companies that are still beaten up. So there's some of that going on. On the competition side, there's definitely, I think it's companies that were competing with venture-backed private companies. So you'd have like a delivery hero that's doing the kind of restaurant delivery around the world, competing against new startups with venture money behind them that were throwing money at the market, being intentionally loss-making, and spending a lot of money on marketing. And a lot of that's dried up. So rational pricing can return to that market, and you're seeing profits come through not because they're cutting costs, but because they can put their prices up more incrementally. That's the story, and it's coming through early in the numbers yet, but it hasn't sort of played out fully. I think that's what we'll be watching quite carefully for quarter by quarter from now on, because it's not fully played out. I don't know if does that answer your question?
It gives me a sense of what you're saying.
And it's for a subset of the companies, it's quite different.
It's interesting. How big is an incumbent that could have $1 billion swing in profits in a 1 year period? Isn't that alarming?
Yeah, well, so they're very big. I don't have the numbers to hand. I could still remember it in the bag, but it's
Just a point, that's huge swing in profits
it is,
in a
yeah.
short period of time.
So it talks to the the concept of investing in loss-making companies, and that the amount they're spending on growing through marketing or customer acquisition or building out infrastructure, will put a huge upfront cost on them, but the benefits, underlying economics are there. And I guess it's our job as investors to see that is the underlying economics there, that when they turn the taps off, or they could turn the taps off, to be able to get that profit to come through. And it was a huge swing, and I suppose I told that story because it's one of the most dramatic ones. It sort of startled us, and I think it talks to a sort of management culture there, where you've got a founder who has the power to be able to, and I think he even said to his lieutenants in the different geographies and different channels, because they've got, as I said, e-commerce, payments and gaming, I think he said, you're not getting paid unless we turn this corner. So it was a very unusual management decision, but as a founder, he had the ability to really marshal the company in that way.
He's responsible for both sides of it.
So how long is it going to take you to turn this sucker around? Why should we stick with you?
That is the key question that all our clients should be asking.
If I was Jack Welch, you'd be out the door.
Yeah. Honestly, I can't answer that question about how long it takes to turn things around. I think that I tried to characterize performance as two components. The company specifics, and I gave the example of ADN, which is the sort of standout, and there's others. There's always be a bunch of companies that aren't doing so well. But on the macro side, that's the big factor. And remember, I can't tell you when Jay Powell will sort of tell a different story around the inflation environment, nor can I say how that will play out in Japan or the policies that are being put in place in China. I would hope that our clients measure us against sort of a market neutral sort of scenario, and I don't know how you would do that. That's not an easy ask, but you need to sort of find if we are investing in companies that are succeeding, and our materials should show you over time the operational progress that companies are making, and I think we should be measured through a market cycle, and this one's been particularly brutal in terms of the rate of interest rate rises, so a pace of an interest rate cycle we've never seen the likes of before. So, I guess our ask is for clients to sort of hang in there and wait for a normal market environment to come back and see how we perform in that part of the cycle. And if we are underperforming in a more neutral sort of part of the market, when companies are being valued on their operational progress as opposed to their duration, then I think it's a time to ask more really serious questions about a growth manager.
You mentioned the central bank. Foreign central banks are pretty much following the pattern of the Fed, aren't they? I mean, they're raising short-term rates.
Yes.
Pretty consistently. China, Japan, and Europe.
In the US, the rates have gone up. In the UK, they've gone up, and in Europe, they've gone up. And all of the inflation patterns follow a similar, sort of spiked 9-12 months ago and on the way down. In Japan, interest rates are still zero, and inflation's just starting to tick up. And they wanted to get rid of disinflation for many years. So in one sense, the central government could see that as a good thing. But interest rates have not gone up yet in Japan. They're expected to do so, and that's coming through in valuations. In China, they're a different part of the cycle. They could cut rates. They don't have inflation, and they could cut rates if they wanted to. A lot of people would have expected China to stimulate its economy by cutting rates. It hasn't done that, and we're not macro specialists. We're in a position to give you any advice or comments on why and when. But I think the direction, if anything, there would be that they could cut if they wanted to, because they don't have inflation and they've got a slow economy and they've got headroom to cut. So there's different parts of the world at different parts of the cycle. And in emerging markets, you had countries like Brazil and Latin America that raised rates much quicker than we did in the West and have inflation under control. So it's a slightly different picture. I think Europe and the US are kind of in lockstep there.
Okay. Any more questions? Brendan, any questions for you?
I was going to ask the kind of relative interest rate question in particular with EM,
Right.
but he kind of just hit on it.
Okay.
Because I would comment, I've heard from some other managers who essentially said, yes, in particular for growth, it has been a very difficult environment, but in a lot of the world outside of Europe and US, they're farther ahead in terms of where they are fighting inflation and interest rates, and going to be theorizing at least that they're a lot closer to cutting rates, which would start to provide that that kind of pendulum shift back from value back toward growth.
Yeah, and if you looked at the range of Baillie Gifford strategies, because every portfolio construction group has its own nuances, but we essentially approach the world in the same way. It's our emerging market strategy that's really held up the best in relative terms over the last few years, and it's that environment that's had less of a recent interest rate sort of story around it. I think emerging markets are used to kind of interest rates go up and down anyway, so it's not a rare phenomenon, but they also have inflation under control, and interest rates from here could go down rather than up. So across the board, our strategies have had a very hard time, and emerging markets has sort of dodged the bullet a bit more from a Baillie Gifford point of view. If I may just spend 1 minute just reflecting on the outlook and echoing a lot of the comments and questions you've sort of sensibly raised. It's been a chastening period. We've learned some lessons from this. I think Kevin Fenlon and I talked about some of the lessons from the portfolio construction group last time we were here to tweak the process and try to be cognizant of the environment. So we're taking the current environment on board, but we're long term and we're not going to change our process. I don't think any of our clients want us to become not growth investors in international markets. We want to stick to our knitting but get better, which is a constant ambition. The fundamental driver for what we are trying to achieve, the key ingredient, the secret sauce for us to succeed through these ups and downs is change in the way economies work, and technologies work, in the way societies behave. And we think that change is actually getting faster. And we've kind of always said that, but I think it's just an accelerating trend, whether that's semiconductors, whether that's healthcare and big data meeting, biotech, or the energy transition that Alexia mentioned at the start of the presentation. I think that secret sauce driver of change is just getting stronger. So that's what gives us optimism and confidence that being this type of growth investor makes sense in the very long term. But to your question earlier, sir, I don't know when the environment and circumstances change.
Well, I'd say if you answered that crisply, I'd be questioning your intellectual honesty. So I appreciate, I understand. Well, one final question, just in terms of the asset flows into the product. Is it people been doubling down? Have you seen assets run off? Has it been stable? I'm just kind of curious over the last, say, 6 months or so, what's been going on there?
Yeah, I don't have the numbers specifically to 6 months, and but no, I think we have not seen clients leaning in. I mean, some clients have, but I think the aggregate flow has been. We've had probably net outflows over this period, and to an extent when we were performing really well in the years up to 2019, and then it was very well in 2020, but that was an anomaly. We saw clients allocating money away because we were outperforming and they were rebalancing away from us. I guess we had wondered whether our clients might allocate in now that we're underperforming, because they'll have the opposite sort of allocation challenge. But I think, and understandably, a lot of people don't feel we've necessarily got to that position of stability that they can confidently think that growth assets are going to stabilize. So I think a lot of clients, if they are ever going to sort of allocate in, and not saying they should or would, but if they were going to, they're waiting for confidence in the outlook. So that hasn't happened yet. There's been modest net outflows for the firm and the strategy.
Okay. Thank you. Any other questions from anyone else? Well, thank you very much. Are you got other meetings here in the U.S.? You heading back? What's your?
We're off to Tallahassee this afternoon. Okay. And Alexia, you're spending the weekend?
Yep, I'm in Washington and then in New York. So I'll be in our office in New York next week as well. Yes.
Very good. Well, safe travels to you both, and thank you
very much.
Okay.
Lovely to meet you.
I've left you the paper. It's some reflections. As I said, we're 20 years anniversary at the start of this year. So Nick Thomas, who's the one remaining ever persistent member of the Portfolio Construction Group, shared some reflections of that 20-year journey. So hopefully it's helpful.
Thank you very much.
Thank you.
Okay. Brendan, you are next up on the agenda.
Good morning. Got a relatively light stack for you today, given that we were here.
Talk about this a little bit before.
Yes, go. Okay, we want to do that. So
Sure.
So
I don't know. It's disappointing, and I'm not saying going where it's going.
Right.
Our job is to advise the city fathers about what they should be doing with their money. I note that their relative share of the total pot is, excuse me, smaller. But
significant.
But still, yeah, I mean, and maybe you say, no, we need to hold the line, and you're a smarter guy than me, but I'm just concerned about it.
Well, maybe we think.
I know we don't have fiduciary responsibilities, but we certainly have adult responsibilities.
See, I think your comment was that international exposure means international companies.
Yeah.
And maybe that's not it. Maybe domestic companies with significant international exposure could accomplish the same thing. Because I think what you're hearing, that political risk now is coming back in a very significant way. And what wasn't discussed was demographics.
Right.
Okay. I mean, the demographics in China and Japan and Europe. I mean, I just read a report that there are going to be no Italians in 120 years, with the birth rates and all that.
Birth rate or water rise?
But you can get the international exposure, and if that were a factor in investing, and it probably should be. But innovation is coming from this country, and the political stability, as chaotic as things may seem, is more here than it is in China. I mean, where is Jack Ma?
Yeah.
When was the last time you saw Jack Ma?
The question is, what companies are they selecting? And, they've had some bad choices, right? And that shows up in their relative performance. I guess my question would be, are you seeing other international growth managers who are outperforming their indexes because, and can you attribute that outperformance to their investment analysis and methodology?
Yeah, I mean, certainly there are international growth managers that have done better. But I will also tell you that they did far worse than Bailey Gifford in 2020, when your manager was up 45% above the benchmark. So some of this is kind of a relative give back, in terms of you had this huge wave, which was artificial is the wrong word, but unusual, and then what you tend to see is some sort of relative give back. But I think that the bigger question, well, international versus U.S. We've just been through a 10 to 12 year period where international has essentially done half of what the U.S. has done. But longer term, they're more or less on par with each other. So are the chances of, for the next, say, 10 or 15 years, do we have international kind of return back to sort of quote normal and start outperforming the U.S. by 2-3% a year on average for the next however many years?
Yeah, but maybe, Brendan, those boundaries aren't as relevant as they used to be. Maybe it's domestic companies with inordinate international exposure.
Sure.
Okay, so that you take advantage of the Brazils and whatever's going on in China and stuff like that. But the political risk seems to be coming back. And
China sees a winner, they can nationalize it the next day.
Do what?
If they see a winner, like the educational group,
Yeah.
it was public one day, private the next. And the private was the Chinese government.
Correct. Yeah, I mean, that is the challenge, I think, and, Andrew spoke to that, there's still tremendous growth. And if you think about it, if you started investing 20 years ago, there was political risk then. Maybe not as much as now, but there certainly was that risk. But for the most part, it hasn't materialized into something that took them out.
When you think of it, you look at the list and you see a TSMC or something, there's enormous risk. And in fact, TSMC is actually moving domestically.
Yeah.
They're moving to Arizona for all practical purposes, in many ways. So I don't know.
But one of the thoughts that I had when you first started to ask the question kind of relates back to portfolio construction.
Yeah.
So within our equity portfolio, we've had, in particular the last 12 or 18 months, the greatest amount of angst about Brown and this portfolio. In a rising interest rate environment, certainly and these are your growth portfolios, the most aggressive pieces within the overall portfolio are certainly being impacted on a relative basis. But if you look in percentages across your equity exposure, you have a lot more kind of value skewed with you know, Barrow Hanley, and Pazina, and even though DGI is kind of on the growth side, they don't quite correlate as much with sort of the growth versus value performance. They're a little more individually focused in terms of their portfolio. But so overall, when you look at the equity exposure, I view it more as an equity or a value lean. And so this, you're still getting some of that beta with the Brown and then this portfolio. So to me, kind of part of that thought is, well, within that equity bucket, do we want to lessen a few of those pieces that are kind of those beta, you know, those generator portfolios, as opposed to Bailey Gifford. Again, portfolio managers go through difficult times. I don't see them changing their stripes. I don't see them saying, oh gosh, what we did for the last 18 months didn't work, so now we're going to go buy value stocks or do something else.
Yeah.
It's, you know, it's sorry, the environment hasn't worked, but we're following the process because we believe that's going to work over time.
Okay, but why don't you take their money and give it to DGI then?
I mean,
I'm sorry, I'm
Sure.
stating the obvious, I think.
In a short answer, it's, again, getting back to the overall allocation with international and expecting parity over time. When you now have international that's so far below US, international, we see it relatively cheap and has underperformed. It seems to me that the odds are better that begins to bounce back. Now, have we had this conversation 2 years ago? It would have been the same discussion. The international had underperformed, and we'd expect, and here we are, it still hasn't really happened. But that's some of the challenge.
You're making the contrarian argument. You're just saying, well, what isn't working now will work later.
Reversion to the mean.
Yeah. I'm not opposed to that. I just feel like we have to ask each other the question, what should we be recommending here? And if stay the course is the recommendation, that's fine. But let's at least think about it.
Yeah. Well, I think also, I mean, trying to think about how do you define what their piece of the square is in terms of, you know, the asset allocation. So you could say, okay, it's a classic, it's international large cap growth with a little bit of ability to wander in the market on their strategy. Or so you say that, okay, that's where the mail gets delivered to the home office. Okay, so we're buying stuff that has companies that have offices where the mail is delivered, not in the U.S.
So you've got twice as much going into your international value as you've got on your international growth.
Which was a cognitive decision we made. The other, or you say, is do we consider Bailey Gifford? You know, are they part of the innovation driver within our portfolio? And we don't really care where their company gets their mail delivered. I mean, there's a variety of ways to look at it than just asset class. I think that's frankly a rather.
All I'm seeing is red numbers.
Yeah. Well, I'm as well. And those type of managers have just gotten their clocks clicked because, frankly, in my opinion, the valuations were nutty a couple of years ago, and they've now reset to less nutty. The question, let me ask this on our rebalancing, right? So we have a pretty disciplined rebalancing that we've gone through, Greg and William. Did we take some chips off the table, you know, when we were doing our rebalancing when they were having their go-go years? And giving it taking from the rich and giving it to the poor, so to speak?
I think we did take some money from Bailey Gifford when they were up last year. Most recently, we took some money from Twin, from Barrow, or from
Most recently DGI and
Twin, because they were the most overweighted from their target. So, I mean, we typically are going to take money from the winners. You know, and over the long term, I think that makes sense. You know.
The other thing that happened also, if you think about it, at the end of 2020 is when you were putting a lot of new money to work. Right. And so they had performed very well. So they got relatively little of that allocation. It was going elsewhere in the portfolio. Mm-hmm. Had you not had the obligation bond come in and were sourcing cash out of the portfolio, that would have been a scenario where likely a lot more would have been coming out from them. Right. But because of that inflush of cash, it kind of reduced that need.
I mean, I've been doing this long enough. Historically, we've just been, I think the discipline of the rebalancing has helped us avoid, I remember DGI, who's, you know, again, one of my favorite managers, but man, they're freaking volatile. I mean, they're rocketing up or they're rocketing down, and we have historically taken, after they've run really hard, And, even, the management team there would say, yeah, you guys have been very, very adept at, selling when we probably were over hot and giving us money when we were, cold, and, then of course they typically run. My sense is, I don't know Bailey Gifford as well in terms of their management structure. My sense is that's probably similar, but I think we insulate the plan some by having a disciplined rebalancing. Because there are times, look, markets are freaking not rational. I mean, they get, they get overheated, way too much, and they also overreact on the other end. And if you're a sane person, it's a hard environment to live through. I think our macro decision to rebalance helps us mitigate that natural risk that we have in our portfolio. But anyway, that's just my assessment. But to point in, when you have that, do they underperform their indices? No, I didn't follow. I know what we changed to the equity from the EFO growth. Could you explain? Was that
officially they changed? As a fund, they have
Okay.
a declared benchmark. It was the EFI, and then they changed to the ACWI ex-US because it includes emerging markets.
God, that's why.
So that was their official benchmark. But in our reporting, we put them. It's still against the EFI,
Okay.
but it's EFI growth. So their benchmark officially is a core,
Gotcha.
even though they have huge growth tendencies. So for our measurement and your purposes, when you've got Silchester on the value side,
Right.
we wanted to measure them against the growth side. So those
Gotcha.
two kind of balanced each other.
So, given their allocation to EM and their nature, what is over the last, let's say, 2 years, what will be the best fit index to measure them against? And are we using that? I'm just curious.
I'd have to look at that because you've got a lot of growth elements in the portfolio.
Sure.
But in EFA growth, you're ignoring EM.
Right.
Then you've got ACWI, which includes EM,
Right.
but is more core in nature. And I'd have to look to see if there is an ACWI ex-US growth. But that's a good question.
My thinking is, if I was going to, take a baseball bat to them and beat them up for having lousy performance, I'd say, okay, did your EM allocation, did that help your relative return, or did that, basically, are we giving them more credit than they should? Maybe they underperformed more, or did they actually do better because of the EM? And I just want to, if you have a measuring stick, you want to make sure you're measuring the right things.
And just to give you an idea too,
Always.
Yes.
over 5 years,
Mhm.
their official benchmark, they are 106 basis points behind. Against the EFA growth, they're 160 basis points behind. So there's a difference of over 10 years, it is a difference of about 65 basis points annually. The difference in the relative performance
All right.
between EFA growth and then it's a bridge benchmark that was EFI that became ACWI. So it hasn't led to a dramatic difference,
Okay.
but their relative performance is slightly better against that core benchmark.
And then the other question, I think you alluded to earlier, I'm curious, I mean, benchmarks, you have to have an objective assessment, but against what we can invest in, right, other real managers. And I don't think we're ready to go passive on the international growth at this point, maybe, but how are they done? Are they really off the reservation in terms of other peers at the moment? Because there's two questions. Are they within their peer group? Do they stink? We need to switch out. And then the macro is, do we want to be investing in international large cap growth at the current asset levels? There's two different decision points.
So certainly over the last, say, 12 months, 70th percentile,
Okay.
lower half.
Okay.
And actually 5 years, 80th percentile. The longer performance in the upper half,
Okay.
because that, as they've been outperforming over those longer periods.
Right.
But yeah, the last 18 months, and it's very endpoint sensitive, the last 18 months have pulled down now 5+ years of relative performance. Where if you looked even just 12 months ago, those 3 and 5 year were outperforming on a trailing basis. But as you've added negative performance, that has continued to bleed across.
Well, you've heard the discussions. You're spending a heck of a lot more time than anyone else in terms of really digging through the portfolios. What's your assessment of Bailey Gifford at the macro level and then at the individual kind of portfolio implementation, using them as our, if we want to stay at that current allocation, that asset class, are they the horse we want to ride? So can you kind of give us your perspective?
Again, in the portfolio construction standpoint, since overall you're relatively conservative in terms of positioning, I like it as that beta generator. Now, because of the nature of their portfolio, they tend to either be, you know, way ahead or behind their peers. You've got some of that relative volatility.
Right.
And so when I see performance like this, it's not entirely a surprise. You know, again, they in 2020, we see them up 45% above the benchmark,
right.
And now we're seeing some of that downside. I view it all, you know, again, as more of an opportunity. You know, it has, now, are we 6 months away? Are we 2 days away from that kind of turning the corner? Remains to be seen, but as interest rates, again, globally begin to stabilize, I think that gets back to a period where those companies tend to do better, you know, where that growth actually matters.
And
I'll give you an argument in favor of staying with them,
okay.
since I've been aggressively in the other direction for a moment.
Yeah. Yeah.
Hey, everything's going great.
Yeah.
You know, give them a chance.
Well, and, I mean, I think that's what's important is you can always look in isolation at any one piece of the portfolio, but when you look at how it's constructed, you have defensive, conservative managers in other places. If every manager is defensive conservative, then the entire portfolio either does well or does poorly at the same time. You have a diverse set of managers, and so for the same reason that a Bailey Gifford and a Brown are struggling relatively, will tend to be the reasons that the Pazzinas, DGI is a little bit of her own, but a Bear Hanley will tend to do well on a relative basis. So overall, as a group, they'll tend to do well.
Which is what this is.
Right. But in any period, you have one or two of those pieces that are struggling. And so that's why, again, I come back to sort of portfolio construction. If we're worried about some of these pieces not doing well on a relative basis, then you reduce tracking error, but you do that across the board, not just with the one area that has done poorly, because again, otherwise you bring that back to the benchmark, and now all your relative performance is going to vary based on those value managers. So if they do well, you look great, but if they don't, now you don't have the beta to offset them. So then you're just kind of changing where that performance happens.
So the question is, are we going to make any recommendation or change? If the answer is no, we might as well just move on.
I guess, I mean, a couple of things I'd like to mention. I mean, first of all, the asset class itself is international. You know, there's a whole concept of portfolio construction, like Rim said, using the capital asset pricing model and the efficient frontier and the asset classes and all that. And, you know, arguably, international companies provide you with a certain opportunity set that you don't get from domestic companies, even though they may have international exposure. So, I mean, I think it's still a valid asset class. With respect to Bailey Gifford's performance, you know, I don't have an issue with maybe comparing what some other international growth managers have done. That's fairly easy for you guys to put together and just look at a comparison. The question to me becomes, you know, is this a temporary issue that they're having, and are they going to come out of it? I would like more information about their portfolio. I know they like to have a very streamlined presentation material, but I'd like to see all their holdings by country and what the contribution to the performance has been within each country. Other international managers provide that, and to me, that would allow us to, you know, look at what they're doing and maybe make a better decision about what we think we need to do.
I think it's a good recommendation. My sense is to hold pat until something other. I mean, if they start changing their stripes from what we hired them from, that's a new determination. In my opinion, they're an asset class that it's volatile. I mean, we weren't bitching when they're up 45%, and we're not happy with them, the negative performance. What I found interesting, and I don't know, I mean, the Adyen, they said the one stock that really kind of blew a hole in their portfolio. From a portfolio, if they have like 10 stocks that blew a hole in the portfolio, I'm like, well, you guys, your process sucks. You get one company, and just, I mean, it kind of idiosyncratic risk. I've seen it where that doesn't worry me as much, because I've also seen managers that they just got freaking lucky on one stock, and they built a career on that, and if you strip that one out, their process wasn't that good. So I kind of liked their process in the past. What I would like to know is he didn't directly answer the question, but in terms of asset flows out, I'd like to understand what that is, because if you get too many assets flown out, now you're blowing up your ability to manage money. All you're trying to do is figure out what am I going to sell today to meet redemptions. But if there's a trend of redemptions, I think behaviorally, let's just say people that have maybe less stronger stomachs than us, if they're bailing, to me that's a sign behaviorally, okay, maybe there's an opportunity. If kind of the weak hands are selling out, almost always that's a counter indication that maybe there's some opportunities that most of the worst is over. But I don't know, I'm just kind of curious the level of redemptions.
Sure. Yeah, I'll ask for follow-up on both what you had mentioned in terms of more specific holding and country information as well as the asset flows.
And so again, as usual, we come in, with sticks and candy, when we talk to our managers, and you're giving both out today, Dave. I appreciate it. Again, based on what everyone said, I'm just sitting here hearing the way we talk. Right now, we just want to stand pat and get a little more information. I think if I were an actual trustee and we had underperformance like we've done with Brown, let's take a look at what other ones look like. And if they're kind of in the same neighborhood, then I think from that standpoint, okay, we can say, okay, it's not so bad. If they're way off the reservation of performance relative to other peers, that I think is a very different conversation. So I think all that would be helpful to help us decide what to do. Sure.
I mean, I think of this as a 9-inning game. What inning are they in? I mean, I would venture to say they're probably in the later innings than the earlier, and they're probably going to get over the hump sooner than later. So do you want to bring in the closer, or do you want to get rid of them? I mean, I don't know. But I think a comparison against the other companies that are, or managers that are available would be very helpful. Maybe bring to light that all of them suck.
Like with
maybe,
Brown, no large cap growth. It's very hard for a large cap growth manager to outperform their index.
Absolutely.
And that's why we've been more patient with Brown, because we realize that. I'm not sure it's quite the same with international. Like you said, they're in the bottom 50% for certain time periods. So.
What are you selling now, William, to meet your redemptions?
I'm sorry?
What are you selling now to meet your redemptions?
Most recently, we did an $8 million total withdrawal from the investment accounts for this fiscal year-end quarter, and we took $2 million from Twin and $6 from DGI because they were the most overweighted. That's typically what we end up doing.
On this fiscal year, DGI was essentially 20% above all of your other strategies in terms of performance. And kind of, again, going back to when we're taking money, we're tending to take it from.
We like to let the winners run for a bit, but eventually you gotta take some money off the table.
Right. And Supermicro is one of their big contributors to their thing. I mean, it's rocked it. I haven't looked at it recently, but again, that always gets me nervous when one stock is driving a whole bunch of outperformance.
Because it can go the other way.
Oh, yeah.
It will go the other way.
Well, and I mean, that kind of gets back to the growth discussion. When you've got 5 stocks that are 40% of the year, 36% of the index, or whatever, it's risky.
Okay, so again, I don't want to.
I'm sorry, but thank you for doing it.
Okay, good. So we're okay. Yes, Harvey.
We talked about Loomis.
Want to talk about it? Okay. What would you like to talk about, Harvey, specifically?
Well, there's got to be someplace better, safe investment to balance this. It's going to return better than 1% over a 5-year period.
Are you arguing for a 100% equity allocation? Is that what I'm hearing?
I'm saying there's got to be something better. Like I'm getting, like I parked some money that I had come in Vanguard, 5.5. And that's just a money market.
Yeah, money market's paying 5.
Yeah,
So why are we
That's-
still here?
that's what we're getting.
I make more money on overnight repos than I do anything else. That's how short-term everything is right now.
Yeah.
Right.
The argument for the other side is, you know, maybe the Fed raises another quarter in November. But for all practical purposes, the interest rate cycle is over in terms of increases. A lot of the pricing is betting for cuts starting early next year. And so in a portfolio, yes, it's certainly underperformed cash because you've been taking the hits as interest rates have been going up. But then you have duration for if and when rates go back down, you're looking at likely double-digit returns out of those longer duration portfolios. So that's the argument for it.
Well, I know, I missed the 30 or 12% of it. I didn't have any money in those days.
But yeah, it has been certainly not a unique conversation for this plan, but for others that are doing regular rebalancing or say, 3 months ago, 4 months ago, equities are running and they're out of range. They want to pull back from equity, but they say, well, we're in a rising interest rate environment. Our fixed income is flat to negative. Why do we put the money there? And there have been plenty that have just put it in money market, left it in cash, even though it's the fixed income bucket, but not putting it with their fixed income manager because of that. But again, I think that's relatively short term.
I mean, anything I would say, if you were gonna, you knew what was upcoming, you might take some money off the table and put it in cash, somewhere for your withdrawals that are coming.
You got your bigger city accounts, what are you getting on them?
So
If you want.
State Street offers what they call a G-STIF account, which I have to check the rate, but I don't think it's paying nearly what, a competitive money market rate is. I'll go back and look at it. So if we actually pulled the money out of the investment account, out of Loomis, and kept it internal at the city, about half the city's cash, it would be commingled with other city cash, even though it would still be allocated internally to the pension plan. About half that cash is invested with the state SBA Prime Fund, which right now is paying about 5.3%, somewhere in there. It backed off a little bit. It got close to 5.5, but it's come down a bit. So that's basically a one-year money market type fund. The rest we have in basically callable agencies, which I'm not being allowed to manage it the way I want to, so it's only earning about 4.5%. I should have been buying bonds for the past 6 months, and I haven't been because of the city manager and the finance director they want cash available, and that's fine, but you ladder in your maturities and your coupons, and that portfolio could be earning over 5%, close to 6% if I'd been allowed to do what I need to, but that's beside the point. So yes, if we put it in cash, we could earn more, but to Brendan's point, when those money market rates start falling, sometimes they fall pretty quickly. And by leaving it, in a longer duration portfolio of fixed income, if you do see the switch in rates and they start coming down, you'll see much better returns on fixed income. So, like with anything, it's timing, and it's hard to pick it exactly right.
If you put new money in Loomis today, what's their effective yield in duration right now, ballpark?
I don't have the duration, but you're yielding 5.5 probably. It's not 5.5. It's not dramatically different than short-term cash.
Right, but you're because it's
But
gone
you-
down. If you add money, you're getting a nice yield.
Correct.
And you probably suffered most of the bleeding.
Absolutely.
I would think. So, but again, looking back, and that's Ravon, it's a fair question. In hindsight, 5 years ago, we would have had cash. But I think at this point, you look, okay, here's the cards we have to play today. I'd be,
Well,
I
the
think
downside risk is greater. If you make a bad decision, you're going to be punished. If you make the right decision, you don't really get any reward for it. From my point of view.
Okay.
If I try to time the markets and pull money
Oh,
out,
yeah.
So it would be nice if I could do it at the right time, but I wouldn't be working for the city if I could do that.
You'd live on the island.
That's right. But going forward, the money that's in Loomis sales at the current price today, our forward expected return, assuming interest rates don't go up or down, is roughly 5.5%.
Yeah.
Okay.
It's much better than it was
Right.
18 months ago, for sure.
Gotcha. Okay.
And I guess just talking about kind of cash flow, you mentioned the principal, we're getting a redemption out of principal. 1.43.
Okay, yeah. And we're just having that stay as commingled cash at State Street. And we'll probably just have them pay manager fees out of that or something like that.
Not quite a full redemption, but at least
Better than
we're getting a piece next week.
Right.
Yeah.
Are there any new or emerging discussions from the formal plan trustees about something they want to change in the plan? We've had a number of, and some commissioners have had some personal initiatives I'd like to see in the portfolio. Has all that pretty quieted down at the moment? Is there anything else?
I haven't heard anything, but
Okay.
I don't speak directly to the commissioners very often. But I haven't heard anything out of the city manager's office
Okay.
about it. I would note that we took, a couple of weeks ago, we took the recommended investment policy statement update to them, and they passed it with no discussion.
Great, okay.
Which was great, and we'll be following up with some other investment policy statements for our city operating funds and retiree health fund and some things like that. But it wasn't an issue. I thought it could be, but
So there's no emerging political discussions we need to be cognizant of or try to get ahead of?
it hasn't been,
Okay.
nothing's been brought up at this
Good.
time, but again, you never know.
I get it.
Has this been presented to the
It
committee?
has not.
Yeah.
I wanted to bring it to the committee. I think a couple of years ago, John, you came and, I don't want to get ahead of Brendan. Brendan,
No.
we still have the performance to summary to review. But it's for you guys to look at and comment
Okay.
on.
So I don't have a copy of that. Yes, obviously, shrewdly keeping information away
This
from
one?
the chairperson. Yes. There it is. Thank you very much. All right. So,
I wouldn't give you a copy either.
you got managing confidence somehow. So anyways, well, so if it comes a point in time to make a presentation, anyone here, I think having the actual people that are giving the advice is helpful along with staff. So just let us know if that's a time, and certainly if I'm available, anybody else is interested, I think it would be great to have an opportunity to address any questions that the commissioners have.
We can schedule it through the clerk's office. They typically don't like to have more than a couple boards or committees do a presentation because, it takes some time.
Right.
But we can discuss it going forward, what dates might work for whoever wants to give the presentation. Staff can give the presentation, but if you guys want to be there, that's fine.
If I'm in town, I'd like to go with you.
Okay, great.
With you.
With me, okay.
So if you let me know I can send out some dates of city commission meetings.
Okay.
They're typically the first and third Thursday of each month. So it would be at one of those meetings ideally, and, let us know what works for you, and we can try to get on the calendar.
Well, I think what's happened in the past is staff have given the core presentation, and if there's questions coming down, being fired off from the dais, and then one of us step up and can answer it. So, again, realize you get your paycheck from these people, so we don't want to, something has to be discussed. We don't want you to have to take
We
care of.
protect you.
Yes, so anyways. Okay.
I'm probably looking right at it, but what is our overall fund rating ranking tier-wise?
It's not in the flash report.
Some quarterly.
We don't,
Okay.
yeah, we don't, on the monthlies, you don't get
Usually
the
like
universe ranking.
Top 1%.
We were in the top 2% for most time periods in June.
Should
But
that be
we're
pointed
probably
out?
going to give some of that back.
I mean, a fiscal year to date, you were number 1. The 3-year, you were 9. 5-year was 57. 7-year 4, 10-year 2, and 2 out to 1994.
Well, that's really bumping around, isn't it?
Sure is.
Well, it's just kind of one little,
Yeah.
one
Yeah,
little
one
notch in there, yeah.
But you can basically say in the top in the top tier.
Correct.
Friends.
Well,
Is everybody on the board certified with the CPPT?
Oh, no, they
No.
never go to those.
That's why they have you guys.
No, but I mean on the PRC.
Oh, on the PRC.
Yeah.
I'm sorry, I thought you meant Board of Trustees.
I'm not.
I'm not sure. We don't require it. We ought,
Yeah,
if
no.
you guys want to, you're welcome to do it, but it's
Yeah.
not
This
something.
has never worked for me to
Yeah.
attend those meetings. They just,
Yeah.
Jacksonville next week.
yeah, see, I'm in Charleston next week. I'm leaving tomorrow. The only reason I'm in town today is this meeting.
Well, thank you for coming.
No, I'm just, that's the way it is.
I think I had a CPP, I think because I didn't go to a couple, I think for a year or two, I was so busy I didn't go. I may have been.
I think you and I got it at the same time when it first came out in the early 2000s.
Right, I think that.
And then I haven't maintained mine either.
Yeah, so, well, anyway, and so we'll talk a little bit about the meeting. I am going to be going to the meeting, for the pension, which it's been a couple of years, so I'm looking forward to that. I don't want to sabotage your presentation, anything.
I mean, it's a relatively light presentation from my perspective.
Okay.
We do have just the update to the S&P chart, which you've seen in the past. I wanted to just bring you the update, one, because if you look way up in the upper right-hand corner, you can see in July, we almost kind of got back to the high. Of course, we retreated then, and then have come off that here in the month of September. But again, just like to periodically update you as this changes, just so you have kind of the updated numbers. Won't go through it unless you want me to, but wanted to make sure you had that.
Great.
And then really kind of just headline, although we certainly have some relative underperformance, in particular Bailey Gifford, who you heard from today, when you look at the fund level, fiscal year to date, so the 11-month number, 2865 versus your benchmark of 1906. Now, a big reason is we have an overweight to equity, underweight to fixed, underweight to real estate. So you're underweight the two areas that are doing the worst, and you're overweight the part that's doing the best. And then collectively, I mean, your equity manager, your U.S. equity managers are up 5% over their benchmark. So a lot of relative, again, system-wide good performance, although we have pockets of underperformance. So really, that is a fantastic number. Through August, I've not seen anyone else above 18%. So not only is this the best number that I've seen through August, it's the best number by about 10%. But again, we're coming back here in September. My rough guess is we're sitting here somewhere about 23.5%, 24% kind of today. So again, not as good as 28, but still very, very good.
How do we take a look at that?
Yeah, that's great.
And again, I'm happy to go through this, but just sort of hit some of the highlights. Bear Hanley, Brown, and Pazina, relatively speaking, did very well for the month. A lot of green. Brown was slightly ahead, but again, some trailing underperformance as we've seen. DGI, a little bit of a relatively poor month, but again, look at the last 12 months, they're over 20% ahead. And again, just took some money off the table, so if you think about it, we took a little bit of money, and they underperformed slightly. And Silchester did well, but of course Bailey Gifford had a poor month. And then Loomis, relatively speaking, relative to their benchmark, is done okay. They're holding up, but it is a very muted return given the environment. But like I said,
We might have to pay Twin pretty soon.
getting there.
Close, awful close.
He may actually make some money someday.
Yeah. I know a lot of his other clients go to.
And then the last piece on page number 9 of it is just, again, the real estate portfolio. I always want to mention, you get monthly updates on performance, so it shows a negative 1.1, but there's nothing for the benchmark. That's only updated quarterly. So I don't want you to think that that's underperformance. It's sort of a misalignment in terms of when that's done. But again, as we mentioned earlier, getting about 1.4 million a year in the redemption from
What's
that.
the annual contribution to the pension plan?
So the employee's rate has been fixed for pretty much 20 years at 5%. The city bears all the risk of return and other liability changes. It just went from a little over 5% in fiscal year 23. Our fiscal year 24 starts on October 1, and it went up to 7.11% because of the plan's negative performance in fiscal year 22. And the plan is no longer overfunded. We are now 94% funded. 94.6. But, you know, I'm not saying we'll be fully funded after fiscal year '23, because remember, there's a 7.75% assumption rate. So if you're down 10%, you're really down 17.75%. If you're up 20%, you're really only up 12.5%.
Right.
Performance-wise. It's all relative to that 7.75% number. So it's nice to be up 20%, but we're not really up 20% as far as the actuary is concerned. But we could be close to fully funded, you know, after '23. We'll see. I mean, the point is, over time, we're going to be okay, I think.
Right. That's great.
He'd be one of the few municipals around that isn't that.
Of course, we got more outstanding pension obligation bond debt than most municipalities around as well, but we're paying pretty good rates on that, so it's okay.
And I'm looking at better all the time.
The average plan, I think, around the state of Florida is kind of mid to low 80s in terms of funding percentage, you know, 83, 84, something like that. So certainly.
We're significantly better than that.
Correct. Again, part of that, again, is the bond. You weren't there
Yes,
4
no.
years ago.
No, I was, yeah, no, I was here when the bond came down.
And so are you going to the
FPPTA?
you'll be there?
I will be there.
Okay. All right. And who else is going?
Are you going?
I'm going to go, yeah.
Great.
Are you
Great.
going?
No, I'm not going
It
to,
starts
January this year.
Sunday.
Okay.
So, but the classes are Monday,
Okay,
Tuesday, and I think they still do something on Wednesday.
Wednesday morning, yeah, the testing is Wednesday, and then they have, for continuing ed, they have, you know, something, you know,
Yeah, so
whatever.
could you sneak in them? I'd love to sit in on a couple of them, but I don't want to pay $970, whatever the hell they
No,
want.
I'm doing it. I'm going to a couple of real estate.
You can try. They have, it varies. There are times that they are very vigilant about that.
Yeah.
You know, needing the badge, like if you don't have the badge, they don't let you in. And other times, maybe someone's not paying attention and you can. But
The
they
trick
are.
is to save your badge.
Yeah.
I probably got
I
a
think
couple
they
of them.
changed the color codes. I've got to go pick up the certification thing, whatever it is, a placard.
Okay.
So I figured I was going to time that one.
Greg can bring it back for you if you need
Yeah,
it to.
no, but I want to
You want to
use it as
sneak
an
into
excuse
class.
to see a couple of them.
Yeah.
But yeah, I won't be probably in session, but I'll be there a good chunk of each day. So, look forward to seeing you.
Great. Any other issues before I ask for a motion to conclude the meeting?
Well, we've had all the discussion you want to have on this.
It's up to you guys. If there are things you want to talk about or review, or you have recommendations, we based this we added some stuff from the previous presentation. We added some data about the pension plan related to the actuarial val, even though this committee's not really involved in that. We figured this was an opportunity to sort of bring them up to speed on that sort of stuff. They request that we list the most important accomplishments, recent accomplishments of the committee. So, I put in some information about the types of asset classes the committee considered and reviewed, and then just a breakdown of investments and that sort of thing, since that's the primary focus of this committee.
Okay.
I agree that it works.
Great. All right. Well, having discussed, no changes then to the presentation, anyone? We'll go with
Oh,
that.
you're not going to put in for a raise for us?
At least
Tight budget this year.
do some donuts or something.
All right, I'd be happy
to
to,
those conferences.
do I have a motion to conclude the meeting?
So moved.
Do you have a second? Second, all in favor?
Aye.
Thank you, everybody. Meeting is adjourned.